The most common question I get asked by beginner investors is, what should I invest in? Should I trade? Should I invest? Should I buy gold? Should I buy crypto? This is an individual question and something personal to you, but what I can do is I can share my own experience with each asset class and the pros and the cons of each. For context, I actually started back in 2017. I was day trading currency pairs, but it wasn't until I read a book called One Up on Wall Street, which I have. This book, One Up on Wall Street by Peter Lynch, that I decided to change my whole outlook and my whole approach to the capital market. So I decided to look more at stocks and shares and investing into actual companies that have real value. When looking at an investment opportunity, you should determine your own risk appetite first and your personal objectives with that investment. If you're looking to buy a house relatively soon, trading and buying cryptocurrency probably isn't the best strategy to do that due to the nature of the asset class, as it poses a higher amount of risk due to the uncertainty tied to crypto. And what you'll realize is that as you progress and as you learn a little bit more, you'll start diving into different asset classes and learning a little bit more about those, and you'll start learning about other strategies that may come your way. So you don't necessarily have to be tied down to one sort of strategy. It all depends again on the risk that you want to take and your overall goals and objectives when investing. Now, when starting your investing journey, it can be a little bit overwhelming. There are so many different asset classes to look at, and some of the common ones are individual stocks and shares, ETFs, government bonds, crypto, and angel investing. These are just a few investment vehicles that you can get involved in. Now, after I put a pause on my trading journey, instinctively I pivoted towards stocks and shares. However, I was unaware that there was a much easier, less risky, and simpler way to get exposure to public markets. The S&P 500 is one of the most liquid markets in the world, and it's very easy to get yourself involved in. This means that there are loads of buyers and sellers getting in and out of the market, so you can buy and sell and get into positions and out of positions without essentially having to wait. Compared to buying a penny stock or even a house, it will take you much longer to find a potential buyer when you look to sell your assets. With some brokers, you can get invested with fractional shares, which basically means you can invest as little as £1 into certain asset classes. This is exactly why Trading 212 is my preferred broker, because of the accessibility it provides. Now, what I've done is I've broken down individual stocks and shares, ETFs and index funds, government bonds, crypto and angel investing, and I've researched and I'm highlighting the potential expected returns you could see from each asset classes. Now, we're going to start off with probably the most popular, individual stocks and shares. Now, it goes without saying that the stock performance and expected returns does depend on the industry that stock is operating within. So for this example, we're going to focus on the tech sector, as that is typically the most popular industry. Now, tech stock returns can depend on a number of different things, such as company size, the stage of growth within that company, and overall market conditions. Breaking this down by market cap, when looking at a large cap tech stock, we can see returns of around 30% or more, depending on the current situation of the market and the current situation of that stock. Now, assuming you bought at a below average price point, you could see even higher returns of these stocks, typically within your likes of Apple's, your likes of Microsoft and Google. Now, smaller tech companies at earlier stages can literally see triple those returns. Now, this can be seen as a much more riskier and volatile investment. These are known as small cap stocks or penny stocks, which can provide nice and lucrative returns, but they do come with that risk as well. Now, probably my favorite vehicle at the moment is ETFs or index funds. Now, there are so many different ETFs to invest in to get exposure to particular markets or sectors or industries. Now, in this example, we're going to have a look at the S&P 500, as the average return for that investment vehicle has been around 10%. And within a bull market, you could see returns of 15% on your investment, including any dividends. However, returns can always change and be depending on the individual stock prices within that portfolio, and also the dividends that have contributed to the S&P do make up a large portion of the overall growth of that index fund. Now, the general pros again of ETFs is the diversification and exposure that it gives you. You're not tied down to one specific industry or sector, as your money is spread across loads of different companies in different sectors and industries. However, there are some cons as well, such as the cap of growth potential. As I mentioned, that you're typically looking at 10% a year on your investment, which isn't bad, but compared to individual stocks, if you're able to get those right, you will see higher returns in individual stocks. But I think it all depends on your approach to investing. ETFs can be seen as more flexible, as they're across sectors and they can invest in different commodities such as gold. However, these do come at hidden costs and charges, which you do have to be aware of before purchasing an ETF. There are multiple different types of government bonds to invest in, such as treasury bills and actual government bonds. The main difference between these is their time to maturity. In this example, we're going to be talking about treasury notes, as they're considered a more medium-term investment with maturities ranging from 2 to 10 years. These are considered a safe investment because they are backed by the government and the government is unlikely to default. So naturally, returns are much lower. For example, if you were to invest £1,000 into a treasury note with a maturity of 5 years at a 3% interest rate, you would receive 3% every year for 5 years until the end of the 5 years, which you would receive your £1,000 back. Now, there are many different pros and cons to investing in treasury notes and government bonds, such as their safety and security that it provides. However, the cons are the lack of returns. You're naturally investing into something that's safer, so you're going to see less returns for that investment. Now, if you was to invest £10,000 into a government bond, yes, you would be locking in that 3%, but could you invest that £10,000 somewhere else? Especially if you're young, you can take on higher risk. Now, it goes without saying, if you had invested £1,000 in crypto 10 years ago, you'd be in a pretty decent financial position. However, crypto does come with its risks, although there is high potential for reward. Now, there's a lot of uncertainty and volatility typically with crypto. You never know if someone is just pumping or dumping the stock, and sometimes when you're investing in a coin or a meme coin, there is no real value within that. So inevitably there will be turnarounds within price once you do invest. Now, the market is open 24/7, and it's even been seen as a potential hedge for inflation when looking at Bitcoin. However, there's no real consumer protections, and if your cryptos did get stolen, then you would essentially have nowhere to go. Now, I personally think that the tech behind crypto is where the real value is at. However, looking at meme stocks and meme coins, they're definitely a much more short-term play. Now, I personally think if you're going to take on that much risk, you should probably look at angel investing. Now, this is a way to provide capital to startups in exchange for equity within the company. Now, this can be very, very lucrative. However, 70 to 90% of startups do fail. So this basically means that the startup hasn't provided enough return to provide back to their initial shareholders. Typically, the way angel investors will realize their profits is through an acquisition or an IPO. Now, this is also another long-term investment which can take 5 to 10 years to materialize, or this could literally amount to nothing. Now, at the moment, I'm kind of sticking to what I know, and that is individual stocks and shares, ETFs and index funds. I haven't really dabbled into crypto as much, and I've never made an angel investment or looked at government bonds. Now, as my investing journey progresses and as my plan changes, I could obviously look to change that depending on certain circumstances. But I'd be interested to hear what you guys are investing in down below. Have you ever thought of angel investing? Because there are tax benefits that do come with it. Now, be sure to drop me a like and subscribe if you found the video helpful.